Bitcoin got cut in half. And BTCI kept paying you every single month. That is the one-sentence summary of what the NEOS Bitcoin Covered Call ETF has been doing in 2026, and it is either the most compelling or the most confusing thing you have heard about a Bitcoin product depending on how familiar you are with how this fund actually works. Because here is the thing about BTCI that a lot of investors do not fully understand until they dig into the mechanics. This is not a fund that promises to protect you from Bitcoin's downside. It does not put a floor under your losses. It does not pretend that you can own Bitcoin without experiencing Bitcoin's volatility. What it does is something more nuanced and more interesting than either of those things. It harvests the extraordinary option premiums that Bitcoin's volatility generates, distributes them to you as monthly income, and keeps your underlying exposure to Bitcoin intact so that when Bitcoin eventually recovers, as it has done every single time in its history, you participate in that recovery without having permanently surrendered your upside. In a year when Bitcoin dropped approximately 50% from its peak and most crypto income products either slashed their distributions dramatically or revealed themselves to be over-distributing by returning investor capital dressed up as yield, BTCI has been doing exactly what it was designed to do. Not perfectly. Not without pain. But consistently and mechanically, exactly as described. Today on Dividend Desk, we are doing the complete breakdown of BTCI. We are covering how the fund's options strategy actually works under the hood, why the rules-based approach matters so much in a volatile asset like Bitcoin, how the distribution rate is set and what drives it up and down, what the boosted version XBTCI does differently, how to think about bid-ask spreads when buying these products, and what the right framework is for evaluating a covered call ETF on something as volatile as Bitcoin. Let's get into it. Before we dive in, if you are not yet subscribed to Dividend Desk, hit that subscribe button right now. We cover income investing, ETFs, market analysis, and portfolio strategy every single week. Hit like if this video adds value. Now let's go. Disclaimer: nothing in this video is financial, investment, or tax advice. I am not a financial advisor. Everything here is purely for educational and informational purposes. Please always do your own research and consult a qualified professional before making any investment decisions. Before we can evaluate how BTCI has performed, we need to understand exactly what it is, because the structure is more sophisticated than most covered call ETFs and the details matter for understanding both the upside potential and the risk profile. BTCI is a covered call ETF from NEOS Investments built specifically around Bitcoin. The fund maintains 100% of its investable assets in long Bitcoin exposure. It is fully, completely long Bitcoin at all times. The way that long exposure is structured splits into two components. Approximately 25% of the fund holds a Bitcoin ETP through a controlled foreign corporation structure within the ETF. The remaining 75% expresses the long Bitcoin position through what is called a synthetic long, specifically using CBOE Bitcoin index options to create a position that moves with Bitcoin's price without directly holding Bitcoin or a Bitcoin ETP. The synthetic long is built using what options traders call a risk reversal or synthetic long structure. Selling a put option and buying a call option at the same strike price gives you a position that moves essentially one-for-one with the underlying asset. If Bitcoin goes up 5%, that synthetic long position goes up approximately 5%. If Bitcoin goes down 5%, the synthetic long goes down approximately 5%. It is economically equivalent to holding Bitcoin directly, but implemented through index options. On top of that full long Bitcoin exposure, NEOS sells out-of-the-money call options on a portion of the portfolio. These are the covered calls. When NEOS sells a call option, they collect a premium cash paid by the buyer of the option for the right to purchase Bitcoin at the strike price. That premium is what gets distributed to BTCI investors as monthly income. The critical design choice that separates BTCI from a simpler covered call strategy is what percentage of the portfolio gets covered. NEOS is not writing calls on 100% of the fund. In the current environment, approximately 50% of the notional portfolio is covered by short calls, with the strike set approximately 10 to 15% out of the money from where Bitcoin is trading at the time the calls are written. Why does this matter? Two reasons. First, only covering 50% of the portfolio means that even if Bitcoin rallies past the strike prices of those calls and the capped portion of the portfolio stops participating, the other 50% that has no short calls written against it can continue to appreciate with Bitcoin. The fund does not hit a hard ceiling. Second, writing the calls 10 to 15% out of the money means Bitcoin needs to rally significantly before any portion of the portfolio starts getting capped. There is meaningful room for the underlying asset to appreciate before the options overhead starts limiting returns. This structure full long Bitcoin exposure plus partial out-of-the-money covered calls is designed to accomplish three things simultaneously: generate meaningful monthly income from the option premiums, preserve significant upside participation during Bitcoin bull markets, and provide a partial cushion relative to simply holding Bitcoin directly during down markets through the ongoing premium income. Bitcoin in 2026 has not been kind to holders. From its peak following the enthusiasm around the new administration's favorable regulatory signals, Bitcoin has been cut roughly in half in price. That is a brutal drawdown by any standard, and it is the kind of market environment that reveals what covered call ETFs are actually made of. For BTCI specifically, the down market has created both challenges and opportunities in a way that illustrates exactly how the fund is designed to work. The challenge is straightforward: BTCI is fully long Bitcoin. When Bitcoin goes down, BTCI goes down. There is no mechanism inside the fund that prevents it from declining when its underlying asset declines. Investors who were hoping a covered call overlay would somehow protect them from Bitcoin's drawdown were misunderstanding what this product is designed to do. But here is where it gets interesting. During the same period that Bitcoin was falling, the implied volatility of Bitcoin options was rising, which it almost always does when an asset is selling off sharply. And higher implied volatility means richer option premiums for the fund to harvest. When Bitcoin is crashing and everyone is scared, option buyers are paying more for protection and speculation, which means NEOS is collecting more premium from the calls it sells. That increased premium income was being distributed to investors every single month throughout Bitcoin's decline. The practical effect is that BTCI has been generating a 1 to 2 percentage point monthly outperformance relative to simply holding Bitcoin directly through this down period. That is not zero. On a monthly basis, that outperformance compounds into meaningful relative protection over time. An investor in BTCI has been doing roughly 1 to 2% better per month than an investor who just bought and held Bitcoin directly, not because the fund protected against the decline, but because the premium income partially offset it. And now, as Bitcoin has begun stabilizing and showing early signs of recovery, the fund is participating in that recovery alongside its underlying asset because 50% of the portfolio has no calls written against it and the other 50% has strikes set 10 to 15% above current prices, meaning Bitcoin can rally meaningfully before the covered portion starts capping returns. This is the covered call mechanism working exactly as designed. You give up some upside ceiling in exchange for income that cushions the downside and outperforms during sideways and down markets. You do not eliminate Bitcoin's volatility. You monetize it. One of the most important and underappreciated aspects of how NEOS manages BTCI is the commitment to a rules-based, emotion-free process. And understanding why this matters requires thinking about what happens to funds that abandon that discipline. Bitcoin is one of the most emotionally charged assets in the world. When it is going up, the euphoria is contagious and the temptation is to take on more risk, write calls closer to the money, maximize premium income, and ride the momentum. When it is going down, the fear is palpable and the temptation is to change the strategy, add protection, widen the call strikes, reduce distributions, anything to feel like you are responding to the crisis. Both impulses are dangerous. Emotional changes to a fund strategy in response to short-term market movements are how funds that looked great during good times become catastrophically inconsistent when conditions change. It is how distribution rates get cut, not because the fund strategy has stopped generating income but because management panicked. NEOS's approach to BTCI is entirely rules-driven. The system looks at the current Bitcoin price, the available option expirations, the implied volatility environment, and the fund's target distribution range, and it executes the strategy mechanically according to those rules. There is no investment committee debating whether to change the approach because of a geopolitical event. There is no discretionary decision to add downside protection because someone on the team is feeling nervous about the market. The rules are the rules, and the rules do not change because conditions are uncomfortable. In the current environment, with Bitcoin having fallen significantly from its peak, NEOS's rules have not been modified. The strike distances are still 10 to 15% out of the money. The coverage ratio is still approximately 50% of notional. The distribution target range of 25 to 30% annualized is still intact. The fund is doing exactly what it was designed to do in exactly the market conditions it was designed to handle. This discipline is what allows investors to trust what the fund description says. If the rules change every time the market gets difficult, you do not actually know what you own. When the rules stay consistent through bull and bear markets alike, you can evaluate the product honestly and size your position based on a realistic understanding of what it delivers. The target annual distribution rate for BTCI is 25 to 30%, with recent distributions running at approximately 27% annualized. For income investors accustomed to seeing 10 to 15% from equity-covered call ETFs, this number may seem extraordinary. It deserves careful explanation. The reason BTCI can sustainably target a higher distribution rate than equity-based covered call funds comes down to one word: volatility. Bitcoin is dramatically more volatile than the S&P 500, the Nasdaq 100, or almost any other mainstream asset class. The S&P 500 runs at roughly 12 to 15% annualized volatility in normal conditions. Bitcoin regularly exhibits 50%, 60%, or even 80% annualized volatility. Option premiums are directly tied to the implied volatility of the underlying asset. More volatility means buyers pay more for options and sellers collect more in premium. Because NEOS can write calls with strikes 10 to 15% out of the money on Bitcoin and still collect meaningful premium, something that would generate very little income on the S&P 500, the fund's income generation capacity is genuinely higher than equity-based strategies. The 25 to 30% target is not manufactured through NAV erosion or return of capital. It reflects the actual income available from harvesting volatility premiums on one of the world's most volatile liquid assets. Now, the dollar amount of the distribution fluctuates with Bitcoin's price, and this is an important distinction that confuses some investors. When Bitcoin falls from $90,000 to $45,000, BTCI's share price falls proportionally. A 27% annualized yield on a $45 fund generates a smaller absolute dollar amount per share than a 27% yield on a $90 fund. The percentage target remains consistent. The cents per share fluctuate with the price of the underlying asset. This is exactly the right behavior. A fund that maintains a fixed per share distribution regardless of what the underlying asset does is a fund that is returning investor capital as income when the underlying is falling, the exact overdistribution problem we have discussed extensively on this channel. BTCI distributes what it earns at a consistent percentage of NAV, which means the distribution naturally scales with Bitcoin's price in both directions. When Bitcoin recovers and the NAV rises, the dollar amount of distributions rises with it. The recent trajectory of distributions validates this framework. As Bitcoin stabilized and began recovering, distributions moved from 67 cents per share to 78 cents to 80 cents. If Bitcoin reaches and exceeds its previous highs, the distribution per share will recover alongside it and could return to the $+ range seen when Bitcoin was at its peak. BTCI has a sibling product called XBTCI, the boosted version, which uses added notional long coverage and additional short calls to amplify both the income and the upside potential relative to the standard BTCI fund. The practical difference is that XBTCI is designed for investors who want more aggressive income generation and are comfortable with the corresponding higher volatility. The boosted structure adds a layer of leveraged long exposure that magnifies both gains and losses relative to BTCI. In a Bitcoin bull market, XBTCI can deliver meaningfully higher total returns. In a Bitcoin bear market, the drawdown is correspondingly more severe. For most investors, BTCI is the appropriate starting point. XBTCI makes sense for investors who have a very high conviction on Bitcoin's long-term trajectory, fully understand the leverage structure, and specifically want the higher distribution rate and amplified upside that comes with it. The boosted version is a satellite position for high-conviction Bitcoin bulls, not a replacement for the standard fund in most portfolios. One practical note on XBTCI that comes up frequently, because it has lower assets under management than BTCI, the bid-ask spread on XBTCI is slightly wider. At a recent price of approximately $46 per share, XBTCI was showing roughly a 4-cent spread between the bid and ask prices. In basis points, this is a relatively small difference, but it is wide enough that using a limit order rather than a market order is strongly recommended. Setting your limit at or near the midpoint of the bid-ask spread gives you a reasonable chance of execution at a fair price without unnecessarily paying away the full spread. This advice applies beyond just XBTCI. For any ETF where the bid-ask spread is meaningfully wider than a penny or two, limit orders are the right approach. They protect you from unusual price movements at the moment of execution, they prevent paying the full spread unnecessarily, and they are especially important when trading near the open or close of the market when bid-ask spreads on any ETF can widen temporarily due to market-making dynamics. Even for the largest, most liquid ETFs in the world, using a limit order costs you nothing and provides meaningful protection in edge cases. This is probably the most important misconception to address directly: BTCI does not have explicit downside protection. There are no put options in the fund. There is no floor under the losses. When Bitcoin falls, BTCI falls. The monthly premium income from the covered call overlay provides a partial, ongoing cushion, typically 1 to 2 percentage points of monthly outperformance relative to holding Bitcoin directly during down markets. Over a prolonged drawdown, that cushion accumulates into meaningful relative protection. But it does not prevent absolute losses when the underlying asset declines significantly. NEOS does have a hedged product line SPYH and QQQH that uses put spreads to add explicit downside protection to their equity covered call strategies. The structure of those products sells some of the short call premium to fund the purchase of a long put spread, which provides defined downside protection in exchange for a lower distribution rate and lower volatility. Whether a hedged Bitcoin product along similar lines makes sense is something NEOS has considered but has not yet committed to launching, largely because the investor demand signal for a hedged Bitcoin product has not been strong enough to justify the development work. The reason is intuitive: most investors who are drawn to Bitcoin are drawn to it precisely because of its explosive upside potential. They are risk-on investors who want to participate in Bitcoin's potential runs and are using BTCI to generate income while they wait. The idea of paying for downside protection that reduces both their distribution and their upside capture goes against the grain of why most Bitcoin investors are in the asset class in the first place. For investors who want Bitcoin exposure with genuine downside protection, the appropriate strategy is probably position sizing rather than built-in hedging. Owning a smaller allocation to BTCI alongside more stable core holdings, rather than a large allocation to a hedged Bitcoin product, gives you the flexibility to manage your Bitcoin risk at the portfolio level rather than trying to hedge it at the individual fund level. Before we close, it is worth spending a moment on the evaluation framework that should be applied to BTCI and every other income-focused ETF in this space. And the framework is simple: total return is the only honest measure of performance. A fund paying a 25% distribution rate and a fund paying a 12% distribution rate cannot be meaningfully compared by looking at their yield numbers alone. The 25% fund might be delivering that yield by overdistributing returning investor capital, eroding NAV, and providing an income stream that is shrinking year over year. The 12% fund might be generating every cent of that yield from actual option premium income while growing its NAV alongside its underlying asset. On a total return basis, share price change plus all distributions received, the 12% fund might significantly outperform the 25% fund. The right way to evaluate BTCI and any competing Bitcoin income product is to look at total return charts from a reliable source, ideally the fund issuer's own website, where administrator calculated returns include all distributions, and compare apples to apples. If BTCI is outperforming simply holding Bitcoin directly since inception on a total return basis, as current data suggests it has been, that is a meaningful and positive result. If a competitor fund with a higher advertised yield is underperforming both BTCI and direct Bitcoin on a total return basis, the higher yield is not actually delivering more value, it is just returning your money faster. The secondary evaluation criterion after total return is tax efficiency. BTCI's use of CBOE Bitcoin Index options, which are Section 1256 contracts, provides the same 60-40 long-term and short-term tax treatment that NEOS's equity products benefit from. For investors in taxable accounts, that tax efficiency is real and meaningful, converting what would otherwise be entirely short-term ordinary income into a mix where 60% receives long-term capital gains treatment. Understanding the tax character of your distributions from your annual 1099 is as important as understanding the headline yield. BTCI is a genuinely well-constructed product in a category that has seen a lot of poorly constructed competitors. The rules-based approach removes emotion from the management process. The partial coverage ratio and out-of-the-money strike selection preserve meaningful Bitcoin upside rather than simply harvesting maximum premium. The target distribution range of 25 to 30% reflects what the options market actually pays for Bitcoin volatility rather than an artificially set number that requires capital return to sustain. And the total return performance relative to holding Bitcoin directly has validated the design through both the bull run that launched the product and the significant bear market it has navigated in 2026. None of this means BTCI is right for every investor or every portfolio. Bitcoin is volatile. BTCI is volatile. The monthly income is real and meaningful, but it does not prevent the underlying asset from declining when Bitcoin declines. Sizing the position appropriately, understanding the mechanics, and evaluating it honestly on total return rather than yield headline are the non-negotiables for any investor considering this fund. At Dividend Desk, we cover every corner of the income investing world honestly and completely, and BTCI is one of the more interesting products in that landscape right now. If this breakdown was useful, please hit the like button and subscribe so you never miss a video. Join the Dividend Desk community, the link is in the description, where we go deeper on all of these products and discuss what we are watching in real time. This is Dividend Desk. We will see you in the next one. This video is for educational and informational purposes only. It does not constitute financial, investment, or tax advice. Dividend Desk is not a financial advisor. Always do your own research and consult a qualified professional before making any investment decisions.